Hi, everyone. I thought I would walk you guys through the first part of Chapter 5, which covers other corporate tax levies, including AMT, Alternative Minimum Tax, the PHC tax, which is a tax on companies that are deemed to be personal holding companies under Section 542, and then the accumulated earnings tax. So I'm going to give you guys a short walkthrough / lecture on AMT, and then in another day or two, I'll walk you guys through PHCs. I'm not going to walk you through accumulated earnings tax section of Chapter 5, nor am I going to test you on it in the quiz or in the homework. Reason for that, and it may just be the types of corporations that I work on, but I have worked on a lot of smaller corporations, closely held corporations, as well as a lot of larger corporations, which is my focus, are the larger corporations. I literally have never seen the accumulated earnings tax apply in my practice. So I'm not going to say you're not going to see it. It's a great idea to read through it in the chapter. I'm just not going to cover it in the homework. Also, as I told you in the syllabus, as well as in the course content in Blackboard, you are not going to be tested on this chapter. So we're going to go from this chapter to next week doing a corporate tax return, kind of like you did the partnership tax return several weeks ago. And I thought it would be a good idea to go through Chapter 5 before we do the tax return, because I do intend on giving you, as part of the problem, you're going to need to fill out 4626, which is the AMT form. So let's just walk through the slides, and then I've got a couple of forms opened up, and I've got the IRS website opened up, and I've got the e-text opened up so that I can show you the chart in Chapter 5 that will be helpful to you, and so on and so forth. Alternative minimum tax. So the alternative minimum tax I think of as system that is in parallel with the regular tax system imposed on corporate and individual taxpayers. And we're only going to talk about this in the context of corporate taxpayers, but individuals also are subject to alternative minimum tax. And as it says here in the slides, Congress passed this law, and it was codified as a way to ensure that taxpayers are paying their quote unquote fair share of taxes, regardless of what kinds of special exclusions or deductions or credits that they're getting under the regular tax system. So, as you might imagine, what the alternative minimum tax system does is it limits the kinds of deductions that you can get. And really what it does more so is it lops off the, in most cases, but not in all cases, it can decrease the amount of deduction that you get for alternative minimum tax purposes as opposed for regular tax purposes. However, as we'll see, sometimes there are some adjustments that can actually result in a negative adjustment, which will actually reduce your alternative minimum taxable income instead of increasing it. So we'll go through that as we go along. You do need to include a Form 4626 for corporate in every corporate Form 1120 every year. And you may or may not be subject to AMT, and we'll talk about the types of corporations that are not subject to AMT, but that would still have to attach the form regardless to show that they're in compliance with these rules. And then I don't know why they stick this on this slide, maybe because it is in coordination with the AMT, but they do state that the accumulated earnings tax, if you're subject to it, is in addition to either your regular tax or AMT. And I think that's just to let you know that it's a completely different tax than your regular tax liability, which could have attached to it an alternative minimum tax liability. So the formula for calculating alternative minimum tax is one where you actually start with your regular taxable income, and that would be from line 28 of your Form 1120, page 1, and line 28 is before NOL. The NOL is on line 29, and then line 30 is taxable income after NOL and special deductions. So you want to start with regular taxable income before NOL. That's what you put on line 1 of the 4626, and this is a 4626. So at the top of the form, you would list the name of the corporation and the employer ID number, and then you would list taxable income before NOL on line 1. So if on the Form 1120, line 28, which is taxable income before NOL, if this number here was $10,000, then on the 4626, you would start with $10,000. And then what you do after that is you're applying adjustments, you're calculating adjustments off in the background, and you're applying these adjustments to regular taxable income to come up with alternative minimum taxable income. Now, getting from line 1, which is regular taxable income before NOL, to line 7, which is alternative minimum taxable income, you're going to have several adjustments that you need to calculate. You're going to have to see whether the company is subject to any AMT adjustments or any AMT preferences, and then you're going to have to do a separate worksheet, complete a separate worksheet, which is on page 2 of the 4626. We'll look at that in a minute. And you're going to have to calculate whether there are any ACE adjustments, which are adjusted current earnings adjustments. So let's go back to the slides at this point. So formula is, if you're going to put this in formula, in terms of a formula, like if you were doing this on an Excel spreadsheet, you would start with regular taxable income before NOL. You would add your tax preference items, and when I say tax preference items, these are the items. Some of these are considered preference items, and some of these are adjustments. So, and it'll explain more in the book and also in the instructions. I want to urge you guys to make sure that you're using the instructions. And where did I get all of this, these forms and so forth? I got these forms from irs.gov, and this is the home page of irs.gov. When I first type in irs.gov, I come here, and then I click on Forms and Pubs, list of current forms and pubs, and then it brings you up to this search box, and I just typed in 4626, enter, and it brings up everything that is a 46, has 4626 in the product number. So it brings up both the form, and you can always hit backspace in the website, and then it brings you right back. And it also brings up the instructions. So if you want both of them up, then just open up another instance of irs.gov or download the form. Like you can download this, right? And then download it into PDF, and that's what I did here before I got onto the webcast. What's this called? Snake It software. Before I got on here, I tried to set myself up, right? So please make sure that you guys are looking at the instructions, because the instructions, actually, you'll see that there are things in the instructions which are covered in the chapter. So for instance, and I'm getting a little bit ahead of myself, but it actually talks here, it has a whole section about small business status, small corporation status. And it talks about the rules behind that, and the fact that once you lose your small corporation status, you can't ever get it back. So let's move on and go back to the formula here in the slides. So you would add your tax preference items, and then you would also add or subtract your AMT adjustment items. So the difference between tax preference items and AMT adjustment items, and those are definitional, they're covered in the instructions. There's going to be a list of them, and there's also a list, by the way, in your book. Where is it? I did have your book up. I don't know what happened to the book. I lost the book. Yeah, I lost the book somewhere. And the reason I had it up in the book, in the e-text book, maybe I can get the e-text back up. I wanted to show you guys. Let's go to chapter 5. This is the e-text. It's the charts are different in my book versus your book. So somebody pointed that out to me. This, by the way, is a nice pictorial of the formula for calculating alternative minimum tax and alternative minimum taxable income, etc., where you start with regular taxable income before NOL, you add your preference items, you add and subtract your AMT adjustment items, etc., going down here. So this is table C5-1. Nice table to refer back to. The one I wanted to show you, however, I'm so dumb. I didn't know there was a, sometimes there's not one of these at the top. Here it is. Topic review C5-1. So this is a summary of common tax preference and adjustment items. So it'll, if it's saying that you could either have an increase or a decrease, that's actually a, if you could have a decrease or an increase, then it's an AMT adjustment. But if you can only have an increase, then it's a tax preference item. This right here, tax exempt interest on private activity bonds, that's a tax preference item. So if you had tax exempt interest income from a private activity bond that the corporation owns, so you're not taxed on that. You remember that back from a few chapters ago. So for regular tax purposes, a corporation is not taxed on its interest income from private activity bonds. That's a tax exempt interest. So they would reduce their book income, which already has that tax exempt income in there. They would reduce it, and they would have what's called a book tax difference. For AMT purposes, you have to add that back in. So, and that's called a tax preference item. So it's going to increase your regular taxable income or your AMT taxable income, okay? So that's an example of a tax preference item. The one that you're going to see by far and away the most is the depreciation adjustment. That's an AMT adjustment, and that can either be an increase or a decrease depending upon the where you are in the life of the fixed asset. And we'll go over the rules on how you calculate depreciation adjustments. The other type of adjustment where you could have either an increase or a decrease is a basis adjustment on an asset sale. So if you sell a fixed asset, if you think about it, if you're going to have a difference in the depreciation that you can take for AMT purposes as opposed to regular tax purposes, that means you're going to have a tax basis for regular tax purposes that is different than it is for AMT purposes, correct? Because we all know that you start with what you paid for the asset. So you paid $100 for, you paid $1,000. I don't think you can get a computer for $100. You pay $1,000 for a computer, and it's a 5-year asset. And for regular tax purposes, you depreciate that asset over 5 years, using makers methods. It's called makers. And that means that you're using double declining balance. In the first year, you use what's called half-year convention, meaning you pretend like the asset was only in service for half a year, so you have to divide by 2, or by 50%, or multiply it by 50%, whatever your answer is on depreciation. That's just for the first year, and for the last year of the asset. That's called half-year convention. And you also use double declining balance, and for a computer, it's a 5-year asset. Those are the rules for regular tax purposes for depreciating a computer. For AMT purposes, you still use 5 years as your life. You still use half-year convention. So you still pretend like it's only been in service for half a year in your first year, and also in your last year of the life. That's how you make up the total 5 years, right? So in the first year, you get a half a year. For the next 3 years, you get a full year. And then in the 5th year, you get the last half of what you didn't get in the first year, right? So altogether, you end up with 5 years, except the middle is 4 years, not 3. So I messed that up, right? So that's how it works for AMT purposes too, except the one difference is instead of double declining balance, you have, and double declining balance means 200% declining balance, right? That's double declining balance. So instead of that, you use 150% declining balance. Now, don't think, oh my God, how am I going to calculate this? This is so difficult. I don't know how to do this on a calculator. You can do it on a spreadsheet, and some people do maintain their fixed assets using Excel. That's a little bit archaic. Most people nowadays use software that calculates it automatically. And the rule is under makers, you use tables. And there are tables in a RevProc, in a revenue procedure that the IRS puts out that show you what the percentages that you multiply times the cost basis each year that mimics all of those rules that I just talked about. So for each year, that table will come up with a percentage which says, okay, yeah, it's a 5-year life, I'm using double declining balance, and I'm in my 2nd year now, so I don't have half-year convention, I have full year. And it comes up with a formula each year to use to multiply times the cost basis. That's what the table is. If you're using software, it does all of this automatically. All you have to do is say, I have a computer and I want you to depreciate it over 5 years and use half year convention, and it does everything else for you. It it has all the tables in the software written into the software. So for AMT purposes, it would also know what to do, and it would use that 150%. So because you're using 150% declining balance instead of double declining balance, which is 200%, you can see that you're going to be depreciating for AMT purposes the asset a little bit slower each year than you would be for regular tax purposes. So you're going to have an add back in the first couple of years of that 5-year life of that computer, but in the last couple of years of that 5-year life of that computer that you're depreciating, in our example, you will end up with a negative adjustment for AMT purposes. And the reason for that is, if you look at the tables for AMT purposes and for regular purposes, what happens in the last couple of years, in the last half of the life of the asset, so if it's a 5-year asset, in the last couple of years of the asset, it switches to straight line. These are just the rules, you guys. I don't make them. It's just, and that's why we have tables, thank goodness, so that you don't have to get yourself all confused. But technically, that's what's happening using under maker's rules with an asset, is in the last half of the life, it's switching from double declining balance to straight line for regular tax purposes. So what ends up happening is, for AMT purposes, you end up getting this bump up. Your depreciation in the last half of the asset's life for AMT purposes ends up being slightly more than it is for regular tax purposes. And hence you'll end up having a negative adjustment. Over the life of the asset, from year 1 to year 5 in my computer, I'm going to end up with the same amount of depreciation for both regular tax purposes and AMT purposes. And what's the total depreciation that I'm going to take on that asset? $1,000. That's what I bought for it. I can't over depreciate the asset. So that's what depreciation is. It's a way of showing, of taking a deduction over a period of time for the money that you laid out in year 1 to buy that computer. The IRS says, look, you're going to have that computer more than a year. So because you're going to have it for more than a year, we're not going to let you take a deduction for $1,000 in the year that you buy the asset. We're going to make you take it over a 5-year period. And over that 5-year period, we believe that a computer will basically lose its value and go down to around 0 after 5 years. And that's what depreciation is. The value of the asset in the IRS's eyes is going down over a period of time. And so for a computer, it's 5 years. For an automobile, it's 5 years. For land improvements like sidewalks and driveways, it's 15 years. They think, you're going to get a lot more use out of that driveway than you are out of that computer. So that's why we have different lives that we're supposed to use to depreciate assets on our tax returns. Okay. I hope that makes sense. So what that means is then, and you guys remember that you're starting with cost basis and then you're reducing your cost basis by your accumulated depreciation each year, right? To come up with a net tax basis. So if you sell the asset after the first year, you would have a half a year's worth of depreciation that you would have taken on it, correct? And in year 2, when you sell it, you'll get another you'll get another half year worth of depreciation, because in the year of disposition, you always get a half year, not a full year. So all in all, you'll have 1 full year of depreciation that you will have taken on the computer if you sell it in the second year. So let's just say that after year 2, you'll have taken $200 worth of depreciation. So now your tax basis is $1,000 minus $200. So for regular tax purposes, your tax basis is $800. For AMT purposes, your tax basis will probably be a little higher than that. And that's because your depreciation for AMT purposes that you're taking is a little bit less than it is for regular purposes. So your tax basis of the computer in year 2 for AMT purposes, instead of being $800, 1,000 minus 2, it might be $850 or $900. So now when you sell that computer in year 2 for $800, you have zero gain or loss for regular tax purposes, correct? Because your proceeds are $800 and your regular tax basis, net basis, is 1,000 minus 200 or $800. So 800 minus 800 is 0. But for AMT purposes, you're now subtracting from the $800 of proceeds a basis of 900 instead of 800. So now you have 800 minus 900, you have a $100 loss for AMT purposes. So what you will have is a negative adjustment in the year of sale for AMT purposes. And on the form where that goes is right here. Where does it go? Right here. 2E. Okay, adjusted gain or loss. And it'll talk about that in the instructions. Because it took me a sec to remember where it is too. Now, how does that make sense to us? We have a negative adjustment in year 2 in the sale. Now, going back in time though, in year 1, when we first bought the computer, we had a positive adjustment, correct? And we had a positive adjustment of $100 in year 1 because we took more depreciation in year 1 than we, for regular purposes, than we could take for AMT. So in the life of this asset, if you looked at the positive adjustments, positive AMT adjustments, and the negative AMT adjustments, you're going to end up with no net difference for either regular tax purposes or AMT purposes over the life of this asset. But as you go along in the life of the asset, you are going to have positive and negative adjustments that you have to place on Form 4626 because the IRS wants us to calculate taxable income in this parallel universe of a system called the alternative minimum tax universe. Okay? All right. So after we apply our adjustment items, we come up with pre-adjusted AMTI. And then we have to apply to that ACE adjustments. And we're going to talk about ACE adjustments in a minute. And we also might have an adjustment for the Section 199 U.S. Production Activities Deduction. You remember from chapter, I don't know if it was chapter 2 or 3, we learned about the Domestic Activities Deduction, DPAD. And that's, you have this concept of QPI, Qualified Production Activity Income, and you compare that to your taxable income, and you take 9% of the lesser of the two, and that becomes your domestic activity deduction. So if you were on, if you're on page 1 of the 1120, here's your domestic production activities deduction line on which you would take the deduction, and that's going to reduce your taxable income. But for AMT purposes, you might have an adjustment that you have to make for that. And that's because when you take it for alternative minimum tax purposes, when you're calculating the DPAD deduction, you don't include any of these adjustments or preferences, but you do include your NOL deduction. When you look at the way the formula works, you're actually reducing your AMTI by your NOL deduction first, but not by your tax preference items or your AMT adjustment items. And then you're comparing that adjusted AMTI, if you will, to your QPI, your qualified production activity income, and then you're taking the lesser of those two and multiplying it times 9%. So you may end up with an adjustment for AMT purposes on your DPAD, okay? And then you come up with AMTI, alternative minimum taxable income, and you might have an exemption that you get to apply to lower it, and then that tax base is subject to a 20% tax. Once you apply the 20% rate to the tax base, you come up with what's called tentative minimum tax, and that is your tax that you're tentatively going to have to pay. But then before you have to pay that, they let you apply against that any foreign tax credits that you've calculated for AMT purposes. And foreign tax credits are actually calculated in a parallel system, just like you calculate regular taxable income and then AMT income. So your foreign tax credit is actually calculated on a Form 1118. And when you would include, if you do have a foreign tax credit to calculate, you would include 2 copies of the Form 1118. One of the copies is calculating the foreign tax credit using regular taxable income as a base. And the other Form 1118 is calculating your foreign tax credit under using AMTI before tax credits as a base. So it gets a little complicated. And then you come up with AMT foreign tax credit and you bring it over to Form 4626. And where it's going to go is down here. So here's our tax base. They call it a tax base in the book, right? That's line 9. That's your tax base. And that's tax base is what you're going to multiply times the 20% AMT rate. And then you're going to come up with your tentative minimum tax before AMT foreign tax credit. And that's line 10. That's the amount on line 10. Then you're going to put in on line 11 your alternative minimum tax foreign tax credit, your AMT FTC. And once you subtract line 11 from line 10, you come up with final tentative minimum tax. And then what you're doing at that point is you're comparing your regular tax liability before application of all credits except for the foreign tax credit, okay? I'm starting to laugh because this is just, it's it sounds so complicated, but you guys, it's very mechanical. And that's why I'm going to have you guys prepare an 1120 next week, is you will see the mechanics of how you go from form to form. And I'm not going to get too complicated with the 1120 that I'll have you fill out. You know, if I have you apply a foreign tax credit, the foreign tax credit will already be calculated for you. I'm not going to have you fill out an 1118, right? So, but it's very mechanical here, but it's a little bit tricky, right? Because you have to read all the words, and that's why you have to look at the instructions. And especially if it says see instructions, please see the instructions. Don't just assume that you know what the AMT foreign tax credit is. And what it will tell you in the instructions is it wants you to recalculate the foreign tax credit for AMT purposes using an 1118, which is why, as I told you before, you'll have 2 copies of the 1118 in a typical 1120. You'll have the regular one and the AMT one. So then what you do is you compare tentative minimum tax on line 12 to the regular tax liability on line 13, and to the extent that your tentative minimum tax is greater than your regular tax liability, you will have what's known as alternative minimum tax. And that's what goes on line 14, and then it also gets moved up into your Form 1120. So here's where you calculate, here's where you actually put your total tax on line 31, which is on page 1 of the 1120. Well, where that's actually coming from is it tells you on page 1 here, it tells you it comes from Schedule J, Part 1, line 11. So Schedule J is on page 3 of the 1120. The 1120 is actually a 5-page form. It used to be 4 pages, but it increased by a page several years ago. So what you're going to do here is you're going to be calculating your tax liability on line 2, but then you're going to apply some other taxes, some other credits, which is going to reduce your tax liability. So what the tax that you're putting, the regular tax liability that you're putting on Form 4626 is the tax liability, which has been reduced by all of these credits here, except for this one right here. It tells you that it wants you to calculate the regular tax liability after all credits, all business credits, except for the foreign tax credit. And that's what you put on line 13. So if you're subject to alternative minimum tax, then your alternative minimum tax is going to go right here on line 3, and it gets added to your regular tax. And what do you suppose line 4 really is? Line 4 is where you add lines 2 and 3. Well, line 2 is your regular tax liability before credits, and line 3 is your alternative minimum tax, which you've calculated on 4626. So what do you suppose that line 4 is? It's the sum of those two, right? So line 4 is really tentative minimum tax. So if you're subject to alternative minimum tax, technically what you're paying in total before application of any credits is tentative minimum tax. And I know it's called tentative minimum tax, but that's what you're paying. So when someone says, and this is the way the lingo that we tax people talk, the lingo we'll use with corporations is we'll say, is he in AMT this year? If he's in AMT, it means that his tentative minimum tax is higher than his regular tax liability. So he's paying alternative minimum tax on top of his regular tax liability. And in total, he's paying regular tax liability plus AMT, which equals tentative minimum tax. And if he doesn't have any credits to apply against that, then that's what he owes on his tax return, less anything that he's paid during the year in estimated taxes. Okay, so that's, I think we've kind of beaten that formula to death. Here's a listing of some typical tax preference items. You're probably never going to see depletion deductions because that has to do with depletion that happens as a result of earth, like earth moving. You know, when if you're the type of a corporation that is digging and has remediation and you have depletion, that's when you're going to see this. I've never had it. I may have had one or two clients that had depletion deductions, but you're not going to see that very much around here in California anyway. The one that you're going to see, if any of these, is the tax exempt interest on private activity bonds that we talked about, which is this bullet here. That's the one you're going to see mostly. Okay, AMT adjustment items. We already talked about the AMT adjustment items, and the most common one that you're going to see is the depreciation adjustment item. So I'm going to skip over that one. We also talked about gains or losses on the sale of fixed assets, where you have a different net tax basis for regular tax purposes than you do for AMT purposes. And in that instance, you'll have an AMT adjustment. That's that adjusted gain adjustment that I already talked through. And this is kind of just explaining in detail whether you have an addition or a subtraction. Another and we already talked about Section 199 as well. You're not going to see long-term contracts very often, so I'll skip that. Okay, NOLs. Those are net operating losses, right? Which, when we are unable, when we suffer a net operating loss in a given year for a corporation, we are allowed to carry back that NOL for 2 years. We would carry it back first if we want to use it against taxable income in a prior year in order to reduce our tax liability. You have to carry it back first 2 years. And if you can't, to the extent that you didn't have taxable income in the prior 2 years, or you've already carried back another NOL and used it, applied it against taxable income and gotten a refund of taxes that you paid in those years, then to that extent, then you start carrying it forward to subsequent years, and you can carry it forward for 20 years. There is an election that you can make to carry forward the NOL only and forego carryback of the NOL. And if you do that, if you elect that, then you actually check a box on the 1120. And why don't we just look at the 1120 real quick, and you'll see where it is. I'll show you. So it's on Schedule K. And Schedule K is your information section of the return, where it asks you a bunch of questions that you answer. And down on line 11 of Schedule K, It says if the corporation has an NOL for the tax year and is electing to forego the carryback period, check here. So you would check there. And if you're filing, what it says here is if the corporation is filing a consolidated return, the statement required by reg section blah 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 must be attached or the election won't be valid. So if you're not filing a consolidated return, there's not an attachment that you need to do. But if you are filing a consolidated return, you must attach a separate statement to the return which backs up this checkbox. Otherwise, the election will not be valid. And it explains this in the instructions. This is a pretty heavy-duty election to be making, because once you make it, it's irrevocable without asking for permission from the commissioner. It's a big deal. So you never want to check this box unless you've checked with the client, checked with your supervisor, have a really good reason for foregoing carryback. You'd want to make sure that you know what you're doing. For regular tax purposes, we can completely offset regular taxable income with an NOL carry forward or an NOL carry back in the case of when you're carrying back an NOL, on what kind of a return are you carrying it back to? It has to be an amended return, correct? Right? Because otherwise you wouldn't be carrying it back. So once you're carrying back an NOL, you're carrying it back to an 1120X, which is an amended 1120. You're not carrying it back to the regular 1120, correct? Because you've already filed the 1120. When you're carrying it forward, you're carrying it to a new return for the year. So for regular tax purposes, you can fully offset your taxable income by an NOL. For AMT purposes, you're limited to offset of AMTI, which is alternative minimum taxable income, to 90% of AMTI. So you have a 90% limitation. Now, for AMT purposes, there's another worksheet that you have to fill out that's on page 2 of the 4626, and that's called the ACE adjustment worksheet. It gets attached to the return behind the 4626, and what this is doing is it's trying to bring AMTI closer to an economic income basis, kind of like EMP, earnings and profits, that you guys learned about a couple chapters ago. So you'll see that a lot of the ACE adjustments are actually similar to an EMP adjustment. So you might not have needed to make them for regular tax purposes, but for ACE purposes, for adjusted current earnings purposes, you do make the adjustment. And let's just look at page 2. Oh, is it not going to give me? Oh, shoot, it's not giving me my I don't know where my ACE adjustment is. I kind of want to show you guys. Yeah. I might not be able to find it right now. It's on page 2 of the 4626. I'm not quite sure why it's not showing it to me here. There should be 2 pages. Anyway, I should have had that ready to show you guys. In any case, you are going to have to fill out the ACE adjustment worksheet as well. And then where the ACE adjustment gets put is down here. So you'll actually transfer from line 10 of the ACE worksheet, whatever your ACE is, your adjusted current earnings, and it goes on line 4A, and then there's just some mechanics here to take you through to figure out what your final ACE adjustment is going to be. And then after that, you apply your alternative, your AMT NOL deduction. And so you're subtracting pre-adjustment AMTI. From pre-adjustment AMTI, you're subtracting your ACE adjustment and your NOL to come up with AMTI. To the extent that you're in AMT in a given year, so that you're actually paying in total tentative minimum tax, then the AMT portion of your total tax that you're paying gets carried forward as a minimum tax credit. And there's a form on which you would carry forward your minimum tax credit. And then to the extent that you are not in AMT in a future year, so in other words, your regular tax in a future year exceeds TMT, tentative minimum tax, then to the extent that you have that situation, you can apply the minimum tax credit against your regular tax liability to decrease it. So in essence, your alternative minimum tax that you're paying in 1 year will be offset with a reduction in tax that you'll pay in a future year. So it's not like you'll lose it forever unless you just keep being in AMT every year. You'll eventually get back that AMT that you paid. This slide is to basically tell you that business credits like an R&D credit, a research credit, and enterprise credits, which are all considered to be business credits, they are allowed as an offset to regular tax liability only, not AMT. You'll see that when you're on the 4626, the only credit that you get to apply against tentative minimum tax is your foreign tax credit. So that's what this slide is talking about. And then it's iterating here that for carry forward purposes, any credits that aren't used are carried back for 1 year and carried forward 20 years. This is just a calculation, a pictorial of how you calculate the limitation on business credits when you're calculating business credits. This is actually done on a Form 3800, which is another attachment to the 1120. So if you have, and the business credit that I usually see in practice is the R&D credit, which is done on a Form 6765. You calculate the credit, then that credit gets transferred to a Form 3800, and it gets combined with other business credits that are coming from other forms other than the R&D credit form, and then it also gets combined with credit carry forwards from prior year that you were unable to use, and then you add all those together, and then you go through this limitation of the credit that is needed to be calculated. And it's very mechanical. Okay, we're on personal holding company tax now, and I'm going to let you guys go because it's been almost an hour. Hopefully this will give you some background for some of the homework problems that have been assigned to you. And I need to go back. I hope that I'm not lying when I say that I didn't assign you any on accumulated earnings tax. But I will go back and look at that because I definitely didn't want to cover it. It's only a few pages of the chapter. It's not the end of the world. But I was hoping just to cover these couple of sections. Have a good rest of the night, you guys. Talk to you soon. Bye.